For the first time in their history, French bonds are doing something that we've never seen before. This goes beyond just political instability, and it spills over into global markets beyond just French bonds. It's what we see from Fitch earlier today and what they decided to do about French bonds and the outlook for them. It gets into why the ECB's path forward is complicated. The ECB saying they don't want to cut rates anymore. They don't think they have to cut rates anymore. But what we're seeing in the French bond market, the historic first, really does complicate that expectation. What ties all these things together isn't necessarily really about France, but what is coalescing in the French situation. I mean, we're already seeing some nascent signs, not for a nascent recovery that European officials constantly forecast, rather some small, maybe growing ripples into beyond US dollar financing, starting with collateral. With France overtaking Italy in all the wrong ways and in unprecedented fashion, that is already spilling over from euro-denominated conditions more broadly. We're even seeing something like US dollar repo fails rising, which can be partly attributed to what just happened with the French bond market. As far as interest rates go, the ECB is going to have an even more difficult time trying to stick with its pause, as French bond spreads also reflect the unease surrounding economic circumstances, which Europe is notoriously bad at overcoming to begin with. The worse it gets for the French economy, the more trouble the country will have trying to consolidate its financing, and the more that's going to spill over beyond just French bond markets. That's the part that no one ever talks about. The fiscal consolidation the French government is attempting is impossible with all of these economic headwinds. In fact, the French political situation and its fiscal situation is downstream of economics. France is embroiled in forgot how to grow before this political instability. And the more that it does create the political instability and bond market uncertainty along with the steepening process on the yield curve, the more difficulty it's going to be for the ECB to just stay on the sidelines and say, we're again worried about inflation when everything is going wrong over here in the economy. As I told you before recently, the French government had already suffered from what was going to be a no confidence vote. And sure enough, last week it was reported the government of Francois Bayrou, a centrist prime minister who had been in office for just 9 months, collapsed on last Monday, in the latest sign of a France reduced to chronic political instability and incapacity to confront its growing financial crisis. The National Assembly, or lower house of parliament, voted overwhelmingly against Mr. Bayrou in a confidence motion he called with the aim of setting out the gravity of France's ballooning deficit and debt and the need to confront them by finding annual savings of at least $51 billion equivalent. The vote was 364 against Mr. Bayrou's government and 194 in favor in the 577-seat lower house, a crushing defeat for the prime minister. And the financial crisis that everyone talks about is the government spending as if the economy was going to recover. Like everyone, they listened to economists a couple years ago during the pandemic and the lockdowns who told them, quote unquote, stimulus would easily offset and overcome the damage that was done to them by the pandemic and the lockdowns. The price illusion of the supply shock made it appear as if all that was true, as if the economy wasn't just recovering easily, it had actually overdone it to the point that it was overheating. That's what central bankers tell everyone. Inflation is a byproduct of a red-hot economy. It's all over the language we use to describe price changes, the hot CPIs and all that crap. But consumer prices instead soared because of an imbalance between demand and supply. Demand was nowhere near red hot. It was just recovering from the lockdowns faster than supply was able to. That didn't imply there was a recovery at all, just a major imbalance between demand and supply. And once the price changes got to be out of hand, that was enough to break down the system before it even got close to recovery. That was the point at which the global economy started forgetting how to grow. It never really forgot. It was just demand destruction, the historical cure for high prices being those high prices. But for governments and businesses that depended upon an actual recovery, they found themselves in deep trouble not long afterward. Spending outpaced taxation, not just in France either, because of the forgetting how to grow in the real economy, especially where it came to labor markets. That's where France is really taking its hit. Since last year, the early part of last year, the labor market there has taken a significant stumble. Even though non-farm payrolls managed to rebound in the second quarter of this year after a couple of straight quarterly declines, the rebound was small and more like a statistical fluctuation than the start of a nascent recovery, as they like to say over in Europe. And has left payrolls firmly below where they were last year, therefore not just a lot of employment taxes that aren't being paid, a lot of increasingly angry French workers and former workers. And they only add more strain to the already strained budget situation. So as the last prime minister got taken out in a no-confidence vote, President Emmanuel Macron said, well, let's appoint the next guy and see what happens here, basically rolling the dice that something maybe positive will change in the real economy and therefore allow fiscal consolidation to move forward. That's the big problem that nobody ever talks about. Before we go on with our video today, let me ask you a question. What if your gold could actually pay you every single month in more gold? That's what today's video sponsor, Monetary Metals, lets you do. And here's how it works. You still own the gold, it's still in your name, it's fully insured, but instead of just sitting there doing nothing, it actually starts working for you. Monetary Metals has built a system that turns idle gold into productive gold, earning real yield paid in physical gold, not dollars. No selling, no trading, no converting. You keep your gold and every month you get more of it. It's a simple idea, but it solves a big problem. If gold is money, it should act like money, and now it finally can. If you're a long-term gold holder looking for a smarter way to store value, check them out at monetary-metals.com/Snyder. Again, that's monetary-metals.com/Snyder. I highly recommend booking a call with them today to see if they're the right fit for you. We thank Monetary Metals for their sponsorship, but now let's get back to the rest of our video. And so last week, French President Emmanuel Macron named loyalist Sébastien Lecornu, a one-time conservative protege who rallied behind his 2017 presidential run, as prime minister last Tuesday, defying expectations he might tack towards the left. The political upheaval this week lays bare deepening turmoil in France that is weakening the Eurozone's second biggest economy as it sinks deeper into a debt quagmire. And that's backward. The debt quagmire didn't create the economic downturn. The downturn sharpened the negatives from the out-of-control deficits to the point they became a paramount focus. The economy comes first. It was out of control, the deficits were, because the economy never recovered after 2020 when everyone said that it was going to. And go ahead and take your spending plans forward because it's going to be this way forever. A new permanent plateau of prosperity. Now contrast that with what's taking place over in Italy. As France further and further succumbs to forgot how to grow, Italy has fared so much better, which means in both the economy as well as the financial situation, fiscal situation, the shoe is now on the other foot. As France's economy has stagnated and declined, Italy's has emerged as a possible powerhouse. Whereas France is victim of forgot how to grow, Italy forgot to forget how to grow. The decade so far in that country has been a sharp contrast, though we have to be careful. There are warning signs in Italy that maybe the Italian economy is succumbing to the 2025 slump that's overtaking the rest of Europe. But even so, the economic, therefore, financial outlook for Italy is far brighter than it is for France or even Germany. That's increasingly reflected in bond spreads and just the nominal yields. Once the poster child for poor finances in the economy 10 and 15 years ago, the shoe really is on the other foot. Italy did the hard work of reworking its economy and financial structures that its larger economy neighbors never really did. And as a result, Italian bond yields have been largely steady since the start of last January, right after the global bond rally emerged in 2023. So where German and French bond curves have been steepening since then, and really the entire global marketplace has been steepening, Italy's long end has been largely stable, with nominal yields trending weirdly sideways to lower, especially this year. So while there's steepening in the Italian curve, it's not nearly as steep as in, say, Germany or especially France. So the BTP spread, which is just Italian bonds, to German bunds has narrowed tremendously as a result. From around 200 basis points back in October 2023 when the global bond rally really got going to around 70 basis points recently. That's a huge turnaround, and it has brought the Italian spread to Germany below the French spread to Germany for the first time ever. So at the same time, With France sinking further and further into the economic forgetting and now remembering how to fire private workers, its own 10-year spread to Germany has increased. So the collapsing of the French government just doesn't help with that uncertainty and the steepening process. So as a result, with the Italy-Germany spread now below the France-Germany spread for the first time ever, that reflects a combination of financial factors starting with mainly economic differentials and the outlook for all of these places around Europe. And so as Bloomberg put it, for market veterans, it's a remarkable development given how lower rated Germany was for years the region's poster child for fiscal profligacy. Now it's France that's worrying investors, with Prime Minister François Bayrou resigning last week after losing a confidence vote. Traditionally, Italian bonds offered a juicy pickup to peers because investors demanded higher compensation for a tumultuous political backdrop and larger borrowing plans, both of which were related to a moribund economy. That's my words. During the height of Europe's sovereign debt crisis in 2012, Italy's yield premium was more than 4 percentage points above France. The spread was around 2 percentage points as recently as 2022, as France fell further into forgot how to grow and Italy never really did. So in recent years, Bloomberg continues, Italian bonds have outperformed as Prime Minister Giorgia Meloni provided political stability in Rome, alongside some efforts to consolidate the nation's debt, which would not have been possible without the economic growth. That's always the key ingredient. Countries always struggle when their economic situation is not there. That's the part they never talk about. Any country that tries to fix its deficit problem when the economy is poor will always fail, at least under the current economics of politics, unless you're willing to go to the absolute extreme, like in places such as Greece. Get the economy right, suddenly consolidation becomes an attainable choice. So the flip in spreads from Italy being far higher to now France is all about that same calculation. Uncertainty over politics and economy has shifted to Germany and France, and that's what's reflected in the bond rates, on top of the steepening process that makes it even more difficult. But this is not just purely national financial matters either. Shifting bond characteristics can also play havoc in the global monetary systems, including the US dollar-denominated flows. In other words, difficulties in the Eurodollar's European components become factors the entire global reserve system needs to take into account. And the problem really starts with Germany. The Germans famously have avoided forever running huge deficits. So quite naturally, there aren't nearly enough German bonds for key monetary requirements like collateral. Since German bonds are seen as the top of the top tier for euro-denominated collateral markets, having so few of them available creates some big problems. The next best where there is any size to make up for that limited availability of bonds comes from places like France and Italy, with the latter in the second half of the 2010s once the European sovereign debt crisis, that disaster faded. But in the latter 2010s, starting around 2018, Italy was gripped by economic dysfunction and chronic political instability too. In fact, in the middle of 2018, right around the end of that May, Italian BTP spreads experienced a massive explosion, which sent everything around the world into a deflationary ripple. Why? To begin with, BTPs are used, as I just said, as collateral for euro-denominated repo and derivatives. So a sudden rejection of the largest block of bond collateral in it, it's going to create major funding disruptions that spill over to European money dealers, who also happen to be important Eurodollar money dealers. So collateral takers who hate uncertainty where it comes to what is supposed to be top tier, unquestionable collateral, they don't take kindly to some collateral starting to be questionable. So if there's an uncertain collateral environment because BTPs are creating disorder for Euro dealers, then they're going to pull back some of their significant capacity across their entire operations, their entire global operations, impacting the entire global system way beyond what's directly affected by Italian spreads. But BTPs aren't just useful in euro-denominated repo or derivatives. They also get relent and swapped for US dollar funding, impacting it in a couple of other ways. European banks borrow dollars in euro bonds or other means, and then they swap those dollars for euros. And I know this is confusing, especially since the Europeans are swapping them to largely US dealers who then relend the dollars to quite a few Japanese financials. But these European banks who are borrowing in dollars and then swapping it back into euros park those euros in some form of safe collateral. German bunds if possible. But without enough German bonds, they've been using BTPs or French oats. So when the BTP spread jumps or the oat spread jumps, it causes quite the problem for European banks who have to factor being less able to collateralize their euro part of that swap, making the swap less appealing, meaning fewer who end up doing it, and leaving the Eurodollar funding markets to suffer the lack of initial dollar lending that becomes available for re-lending also across the rest of the world. But as I said, those negatives that used to be from Italy with rising Italian spreads are now being more French. Oats are becoming far less reliable, more uncertain for collateral takers to consider. So collateral takers might be taking a lot less oats as a result, which is a problem because Europe does not have alternatives, especially without Germans issuing tons of bonds. So with fewer alternatives to choose from, it tightens up collateral flow in the same ways that BTPs used to do back in, say, 2018 or again in 2021 and 2022. And so ever since last year's political and economic upset, oat spreads have jumped and remained high, moving back and forth since the middle of last year. It actually started last June when the ECB cut for the first time, which is a key signal, again, relating to more economic weakness. I mean, central bankers chase that economic weakness with rate cuts. And it also kicked off the start of the steepening process on European curves. So right after the ECB cut, the European parliamentary elections, especially in Germany and France, went poorly, especially for the French government, which was quickly followed by the unwise decision by French President Macron to call snap elections, which just blew up in his face. And it's been an unstable mess ever since then, alongside an economy that is very clearly forgetting more how to grow, at the very least, if not remembering how to fire. So with French spreads reaching and now surpassing their Italian counterparts, we do see a small shakeup in the effect in global finance, with a potential small rise in US dollar repo fails, more recently possibly related to the latest shakeup in French spreads and the fact that French spreads are now overtaking their Italian counterparts. And it all relates to economic outlook and the differentials there. Italy being in a relatively better situation than either France or Germany, and that's reflected in not just those spreads, but just nominal yields in Italy as well. And so as the world shifts its negative attention to French oats, we watch French oats spreads rise as a potential sore spot. And then we get news today that ratings agency Fitch has taken action against France. Fitch downgraded France's credit rating from AA- to A+, with a stable outlook, citing a, quote, high and rising debt ratio, and warning that political fragmentation was hindering fiscal consolidation. That's a term you keep hearing over and over when you don't hear the term that should go along with it, macro deterioration. For its part, Fitch projected that France's fiscal deficit would stand at 5.5% of gross domestic product in 2025, down from 5.8% of GDP in 2024, but warned this was still high compared with the projected Eurozone median of 2.7%. In addition, Fitch forecast that French debt would increase to 121% of GDP in 2027 from 113.2% in 2024, quote, without a clear horizon for debt stabilization in subsequent years. And yet again, it's the economy that's the key factor in this fiscal consolidation process. You pair a little bit of fiscal sanity with legitimate and sustained economic growth, and consolidation happens, not by magic, but by reality of economics. Instead, the only thing that's ever offered to cure the economy is more of the same quote-unquote stimulus that never stimulates. The ECB cuts rates, which only reflect the weakness of the entire continent. They don't actually fix it. And so the worse it gets, the lower rates go, the worse it gets in the real economy and in the outlook for these various budgets. They can try all of these consolidation tactics that they want. Without a healthy economy, their only choices are more uncertainty and political instability, or being forced to the extreme end like some of their other southern neighbors, such as Greece. See, that's the thing about these spreads and rising nominal yields. It's not about rising growth and inflation expectations. It's not inflation expectations that's boosting yields and therefore boosting spreads. It's the fear that if this continues to go on, if the economy still refuses to get into its nascent recovery, then someplace like France might be forced further and further in the direction of like we saw with Greece. And what does that mean? That means some big trouble for French bondholders. It means big trouble for a lot beside French bondholders and French markets. It is the the true downside case where extreme measures need to be taken, all because the economy is not performing. So European bond curves are all steepening, but not all steepening is equal. You've got fears in France that with an economy that fails to recover, the nascent recovery that isn't, with that happening and with political instability on top that's feeding into everything, that the way forward for the French government is not just clouded with uncertainty, it's clouded by forgot how to grow at best. And so that has reignited some volatility in French bonds versus others, including Italy. And Italy has performed better because of its more favorable economic situation and forecast. So there are direct consequences where uncertainty steepens the French curve a little more than everywhere else. At the same time, there are indirect impacts in places like collateral markets in Europe and even beyond. All these negatives only add more headwinds to the European economy, which is struggling just to stay in the forgot how to grow category, even after almost 3 years of it already. Policymakers keep talking about a nascent recovery, and even if there was one, it's not going to be able to get going with even more of this volatility thrown in front of it. Rather than there being some spark, some catalyst for a genuine nascent recovery, Europe keeps experiencing all of these major headwinds that keep the ECB, as a start, whether it knows it or not, locked into this race to the bottom. And that race to the bottom goes a lot more than just for Christine Lagarde. Related or not, we've already seen quite a bit of evidence for tightening in Eurodollar conditions, especially where it comes to the world selling U.S. treasuries, not because of politics, because of monetary mechanics, and that's all in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers, and until next time, take care.